Hi guys, Chris Weston here, Head of Research at Pepperstone. So it's been a big few days in the gold market. We've seen one-way price action. I think the really interesting development now is you've got a lot of systematic funds coming into the gold market, certainly in gold futures. As gold's going up, a lot of the trend following systematic money is drip feeding into the gold market. They're getting long and increasing length in gold futures. Obviously, that's having big implications for spot markets as well. But it's more precious metals more broadly. And I think the last few days we've seen some really big information coming through, which has made people want to go out and hedge themselves against inflation risks. You're looking at break-even rates, five-year inflation swaps, whatever your market-based level of expected inflation over a specific period. It's been moving higher, and we've seen as a result of those higher inflation expectations moving up at a faster clip than nominal treasuries, is that real rates are becoming deeper negative, and we've actually got record low rates coming through in 30-year US treasuries and record low real rates in tens and fives. In the UK, that's a similar thematic as well. So where's the best hedge against that? Well, Bitcoin's been doing well. Crypto's been doing quite well as a hedge, I suppose. Gold's been finding its form, but the gold's been moving up concurrently with a stronger dollar. And the two factors here is that the US economy is looking pretty good. I think we're going to see a situation where, if you look at payrolls, the level of job creation is pretty strong, and what we saw there is on a non-seasonally adjusted basis, we saw easily the biggest level of job creation this year. Well over 1 million jobs were created. And those seasonal adjustments will roll off into the November numbers. And so we're going to see a very strong level of job creation there. We've got to keep our eyes on that participation rate. The Fed are making an assumption that the participation rate in the labour force is going to increase from 61.6% closer towards 62.5%, perhaps 63%, which is where we were pre-pandemic. If that's not going to be the case, if that participation rate stays as it is and we see a strong level of job creation, then we're just going to see the unemployment rate in the US coming down to 4%, which effectively is the maximum employment threshold, where we're going to really see those wages spiral up if that's going to be the case. So I think we're looking at a situation where by year end we're not just going to be well in excess of where the Fed's economic projections are for the unemployment rate, but also after what we saw last night with the core PCE number and the headline inflation number at 6.2%, is those core PCE numbers are going to be significantly higher than where the Fed would have been assuming as well. And that leads us to believe that not only are we going to have a conversation around an earlier tapering timeline, but also we're going to see more rate hikes being priced into the market. And I think let's have a look at what we're seeing in terms of rate hikes before we start going into the dollar and charts and bits and pieces. Because I think if we look at the swaps market and look at what's priced into certain current countries at the moment, in the US, we've got 56 basis points of hikes being priced in over 12 months. So that means 2 rate hikes if we work in 25 basis point increments. Go out to 130 over 2 years. Now, have to put that into retrospect. I mean, in Australia, we've got 83 basis points being priced in over the coming 12 months. It's not going to happen. There's not going to be 3 rate hikes in Australia, in my opinion. I could be wrong. I'm often wrong, but I don't think that's going to be the case. So I think taking negative views on Aussie dollar just based on what's being priced into the Aussie curve is something there. We're not going to see the cash rate at 153 basis points or even higher over the next 2 years as well. So immediately from that perspective, you can talk terms of trade, iron ore, bulks and various factors, but from a rate setting, you can look in there, you can look in New Zealand, 233 basis points over the next 12 months. In the UK, if they pull Article 16, I just have no idea how they're going to pull 4 rate hikes out of the hat there. So when you're looking at these different countries, what's pricing over 12 months and what's pricing over 2 years, it feels like with everything that's going on in the US that we're actually seeing rates pricing quite conservative. The other aspect that we really want to look at is unit labour costs. This is, along with a participation rate in the US, is probably the most important indicator for me. So we've got the labour costs, labour unit costs are 4.8%. So we're seeing compensation rise, we're seeing productivity fall, and that will lead core PCE by about 3/4 as well. So they're the two probably the biggest impacts for me in economics, along with things like credit as well. But we can see from a rate perspective that what's being priced in the US, I think, is actually quite conservative relative to and realistic relative to a lot of other countries. So let's have a look at see what's happened to that dollar as a result, and we'll get into the gold price in a second. Because the dollar's broken out, right? The dollar is looking really strong now. You can see that on the dollar index, breaking through that 94.50 highs. It's just powerhouse. Is this going to break 95 fairly soon? We're trading at the highest levels really since September, and we're not a million miles away from breaking that and getting to the highest level since July. So the dollar is in beast mode at the moment. It's a momentum dream. All the trend following people are involved in that. You can see euro dollar, which of course makes 57% of that, breaking through these swing low October swing lows. Rallies are to be sold in euro dollar, in my opinion. Whether you're looking at it from a rate differential perspective, when you're looking at it from what central bank divergence are playing through with the ECB really quite aggressively pushing back on rate hike expectations, that's looking pretty good. And again, you can have a look at the Aussie dollar as well. Aussie dollar looks like it's a sell on rallies kind of candidate. We're pushing this 61.8% Fibo if this moves. So yeah, might see a little bit of a bounce technically, but we're below the 50-day at the moment, and this is trending lower. We're not oversold in any kind of great capacity. So I'm selling rallies in the Aussie dollar from a rates perspective, also from a trend and a flow of capital until price can close back above this sort of 5-day exponential moving average. I think this one trades lower in the market at the moment. And also the pound's been an interesting one. Let's have a look at moves over the last 5 days, give you some perspective about where what's been moving. Let's have a look at it against the dollar. Just bear with me a second, please. Okay, so over the last 5 days, you can see that the pound's been the weakest currency. So actually being long of gold in sterling terms has been the best trade. Obviously, we're trying to get double bubble, get bang for our buck. We want to be long gold or long of any asset in the weakest currency or the perceived weakest currency. We want to be strong. We want to be short of gold in the strongest currency or the perceived strongest currency. So being short over the last 5 days, being long of gold in pounds has been a good trade. Any of these currencies has worked quite well, and I'll show you those charts in a second. And if you have a look at the precious metals place over the last 5 days, you can see it's been a pretty good hedge against these inflation expectations we've been seeing. Gold's been moving up. In fact, gold and silver and these metals have been moving up in every currency term. That's a real sign of a strong bullish market when it's been moving up in every currency term. It's been outperforming. It's been used as an asset in its own right rather than just a currency play. And if you have a look at the gold in pound terms, it's up 6.7%. Silver's up 7%. So that's really been where you're getting that move. Let's have a look at the charts then in terms of gold. You can see here we've obviously broken the downtrend. We've just been up 6 or 7 days in a row now. We did, after the CPI number, get up to 1868. A few sellers found lurking there. So that's perhaps just a little bit overbought. And we've sort of come back. The question is now, can we come back to this to retest this breakout area, find support, confirm it as support, and then bounce off there? That would be a very powerful signal indeed, something I'm watching out for. But have a look at these moves that we're seeing in some of these other currencies. Gold and euro terms, absolutely flying, gone for it. In sterling terms, talked about how strong that's been, gone for it as well. It's a bit overcooked at the moment. So again, just looking for a little bit of a pullback. But if we do see it coming back into this 5-day exponential, the market holds that, it doesn't close below that, that could be a buying opportunity. Have a look at it in yen as well. Again, very, very strong indeed. So they're all just absolutely gone for it at the moment. It's been a very, very strong market. I think silver's interesting here because if you look at silver, we traded above the previous high. We couldn't quite hold those levels. And we've seen a bit of a failed breakout. We have had an engulfing, well, it's not quite an engulfing, but you can see that it would have been nice the bulls would have liked to have seen a close above that level there, 24.88. It hasn't happened. Still looks pretty strong. I think we'd probably wait for a close above that level before taking long for a trend position, a momentum trade. But it's looking pretty good. Actually, if you have a look at the gold silver ratio at the moment, you can see this head and shoulders pattern emerging. The way that I'm going to be looking to trade this, there's not a trade right now. The price action's a bit messy. It doesn't really know what to do. But I think if you get a break of this 50-day moving average, you get a break above 76.27, I think you'd be long gold, short silver as a pairs trade there. On the other side, if we do get a close below the neckline of this head and shoulders down at 72.81, I think being short of gold and long of silver would make some sense there as well. So one that we are watching in that trade. If we go into some of the other markets that we're looking at, crypto. Now, crypto's been doing very well, but we're now starting to see a nice bid come out of the market. We saw it, what was essentially, with the benefit of hindsight, this kind of failed breakout. Had a sort of pop above the precipice. Didn't like what it's seen. Really unconvincing price action there, and now we've got the engulfing pattern playing through. So, do we now trade down into 27,666? That's the question we're looking at. It looks like there's change of structure, but really struggling to get long of Bitcoin at the moment as a trade until we can really make a stage there and actually start trending higher. Ethereum's been well traded by clients, but you can see we're testing the bottom end of this channel at the moment, so that's been a big one there. And you can see DOT, which is really seeing some big selling playing through today, down 10%, but it's just holding this level, so that'll be an interesting one. Can we now find this as a buying opportunity into that mix? Let's have a look at some of the charts that I'm looking at. We talk about real rates, and you can look at this against gold. Now, real rates have moved a little bit off the lows. So this is inflation-adjusted US Treasuries. We know gold is a hedge against falling real rates. And you can see there that as this has moved lower, gold prices have moved higher. So that's what we continue to see. Are inflation expectations going to continue in earnest going forward? That's going to be a big question for markets. But if we do see inflation expectations outpacing nominals, this will continue to fall. And if this continues to fall, then those gold prices are going to go up to 1900. The question is what currency do we want to be long in? Is it going to be something about buying in a weaker currency? That's what we continue to watch. If I have a look at the optionality market at the moment, you can see that 1 week implied volatility in gold's trading 13%. So it's not been explosive. People are saying, fine, we like what we're seeing in the gold market, but we're not expecting these powerful massive moves, these big impulsive moves to play through. If we have a look at risk reversals, which looks at call volatility minus put volatility, we can see that call volatility, the right to buy, positive bullish structures, are now trading 0.79 vol premium to call. So the market, if you're looking at that as a sort of a sentiment gauge, is quite constructive on gold. But if we were trading about, say, a premium of 3 on calls, 1 week calls, then I'd be saying that we're probably pricing a little bit too much optimism in the gold market. We're not there at the moment. So sentiment is certainly positive, but it's not by any means overcooked. One thing we are looking at now is if you have a look at price relative to the 5-day exponential moving average, I'm just working out, has that elastic band been pulled a little bit too far? Are we pricing in a little bit too much? Are we due to get a bit of mean reversion? And what we've got is a situation where let's go in over recent times. So I'm looking at price and the percentage over or below the 5-day exponential moving average through this period, last couple of years. We see the average here, the blue line, and this is 1 standard deviation, 2 standard deviations above and beyond. Generally speaking, we are now getting to levels where price has mean reverted a little bit back to the 5-day exponential moving average, so 1.6%. So we are probably a little bit overcooked. I probably wouldn't be adding to any kind of longs here. Maybe a little bit of pullback into that retest if we're using this as a model just to give us a sense of whether things are a bit overcooked. And again, we come back down into the gold chart. And we can see, it's probably just in time that things here are just extrapolated a little bit too far and just a bit of mean reversion. So again, just playing to the idea that we may well creep down into this back to the retest and see how it goes. So a lot of signs that things are looking pretty good at the moment. The dollar looks great. I'll be looking to buy pullbacks there. Certainly, euro dollar goes lower, in my opinion. Aussie dollar goes lower. But we are watching what happens in real rates, and we continue to watch what happens in the gold market. Yeah, it's broken out. Can this continue? I think but the bond market holds all the keys there, so something that we are going to be watching going forward. So if you find yourself liking this video, obviously hit the like button, and if you really like the video, hit the subscribe button as well. Do wonders for the channel going forward. But yeah, really constructive moves that we're seeing in the gold market. The market is getting quite concerned about this inflation story, and they're using different hedges to do that. Of course, gold's one of those.